Welcome to the Market Pulse podcast from Equifax, where we break down the latest economic and credit insights to help you navigate today's business landscape.
Hello, and welcome to our Market Pulse webcast, where today we are going to be talking about the state of consumer wealth and the overall condition of the U.S. consumer in general. But first, let's have an overview of the economic condition within the United States by Justin Bagley of Moody's. Justin?
The U.S. economy continues to weather a string of significant shocks. In just the past year, the economy has grappled with broad-based tariffs, restrictive immigration policies, and a global energy price shock from the war in Iran. But the economy's resilience appears tenuous, and it wouldn't take much for it to falter. For the economy to grow, consumers need to do their part and maintain their spending. And they are, at least in the aggregate. Real consumer spending grew just over 2% last year and has continued to grow at a similar pace in 2026. Nominal retail sales growth cooled in June, rising just 0.2% after advancing an average 1.1% over the previous 4 months. Much of the deceleration, though, was due to lower gas prices. And if we exclude gas stations, sales rose a healthy 0.7% on the month, and the breadth of the strength in core sales suggests that households used some of the relief at the pump to buy other goods. Now, the decline in energy prices stemming from the temporary ceasefire agreement between the U.S. and Iran resulted in meaningful inflation relief in June. The consumer price index fell 0.4% on the month, lowering the year-over-year inflation rate from 4.2% in May to 3.5%. However, hostilities between the two nations have escalated over the past few weeks, causing oil prices to rebound above $80 per barrel. This is well below April's peak near $120, but suggests that high energy costs will once again put strain on household budgets in July and in the coming months if sustained. And this will negatively affect the consumer outlook. The level of anxiety among consumers is already unprecedented, even in the deepest of past recessions. Consumers are still recovering from the post-pandemic inflation surge and are generally discontented with the higher price level. Tariffs have exacerbated cost of living concerns, and the recent jump in gas prices has further squeezed household budgets. And the labor market is also wobbly, as demand for workers is soft and real disposable incomes are virtually unchanged from the past year. Meanwhile, credit stress is rising among the most financially vulnerable subprime cohorts, and there is risk that performance deterioration could become systemic if the labor market weakens further. For now, Moody's Analytics expects that the consumer will continue to support the economy through the rest of 2026, but downside risks abound.
Thank you, Justin. Today, we're going to be addressing a topic that many of you have been telling us is of high importance to you, and that is the state of the U.S. consumer overall. And what is the impact of consumer wealth on that condition and their ability to handle affordability as prices continue to rise? I'm joined today by our IXI Chief Strategy Officer, Ian Wright, who's going to help us unpack some of these details, and we'll dive into how different populations are being impacted by the economic conditions in different ways. So, Ian, thanks for joining us.
Thanks, Tom. Happy to be here. Looking forward to our conversation.
So, one of the ways that we're going to frame this conversation is sort of setting the stage by talking about how different populations are defined. Before we even start going into how they are impacted by rising prices and other economic conditions that we're seeing today. So we all know that it's not a blanket condition that all people are affected equally by rising daily necessity prices like utilities, food, rent, and so forth. But rather than infer these issues, we want to actually put some quantifications, put some definition around these. So we're going to be referencing things like the K-shaped economy to illustrate how some people are actually thriving in these conditions and others are struggling, and what's happening to the people in between. And we're also going to be talking about the impact of wealth and other consumer finance elements on those trajectories that different populations are going. So to start us off, though, we thought it would be useful to have a brief overview of what the overall conditions are like. And I'll ask Ian to give a state of what he's seeing in terms of the overall wealth of the U.S. population. And I'll follow up with some insights around the credit. So, Ian, if you could take a stab at giving an overview of what the wealth conditions are like out there.
Sure, I'd be happy to. And from a top level, high level, across the national story, it's been a great story, actually, since the Great Recession. So about the last 18 years or so, we've seen consumer wealth really skyrocket with a little bit of a hockey stick growth, especially since COVID. So if we look at post-COVID, let's say 2021, we've seen consumer wealth grow by about 20%. And I should mention, when we're discussing consumer wealth, the way we define it is liquid assets. So the deposits that you have in the bank and your investments that you can move between institutions. So those that you control, joint accounts, IRA accounts, but not your workplace savings that are locked up and associated really with your employer. So it's that liquid wealth that consumers can bring to bear to pay for their necessities of life and also for their discretionary purposes, and use themselves to plan for the future. And with that 20% growth, our last figure has consumer wealth at $74 trillion, with the last year that we've got data for, the growth being about $8 trillion. So again, at a very high level, it's been a fantastic story. But I think, as we'll see when we walk through some of the numbers and break them down in the populations, you'll see not everyone has been able to take advantage of that growth. One of the metrics that shows that, if we looked at wealth in 2021 versus 2025, we wanted to see what the typical consumer had in wealth. How are they doing overall for that mythical kind of middle? Well, it's not mythical. It is the middle household in the U.S. And we use medians instead of averages because ultra high net worth households can really skew some results. We did that. We looked at the median household wealth in 21. We compared it to 25. It was $75,000, which is a fairly good number, but it actually went down by 1%. So if we had that 20% increase in that time period, why did the median go down? Well, I think we'll see it's because we didn't see a significant number of households be able to take advantage of that growth.
Yeah, and you hit upon a number of really key things that we're going to go deeper into during the course of this podcast here. That difference between just something as easy as average versus median, and how they tell different stories because of what's happening underneath those top level numbers, and we'll certainly dive into those. From a credit standpoint, we've also been seeing a rather encouraging story again at that top level that you referenced. So when we look at those high level numbers, we look at things like delinquencies, auto delinquencies, card delinquencies, personal loan delinquencies. Those have actually been very stable, and in some cases even declining overall, for the past couple years now. Certainly when we entered the pandemic period several years back, conditions dictated that delinquencies sort of became artificially low. We were all staying indoors. We weren't spending to the same degree that we were before. And we were getting stimulus checks, and there were other conditions that helped many of us not only help pay down some of that higher interest debt, but also build up savings and build up some of the wealth that you've been seeing accumulate over the last several years. And we knew that wasn't sustainable. At least we were hoping it wasn't sustainable, because we were hoping to come out of the pandemic and resume life as usual. And to a degree, that's what happened. So it wasn't a surprise when we started to see credit card and auto delinquencies start to rise, and some of the other lending categories start to rise as well. The question was, how fast and how far are they going to rise? How much reliance upon debt are people going to be coming back to? And that's where we've been seeing a number of the interesting stories. Yes, delinquencies did come back to pre-pandemic levels, and in most cases actually exceeded it a little bit. But like I said, they've largely been stable. Mortgage has started to really pick up lately, and we're keeping an eye on that. But overall, the delinquency story is rather solid. But we start to look at other things like the rise in consumer debt, and there we see not just a rise in total debt, but also particularly the rise in revolving debt, people utilizing their cards for larger and larger portions of their overall spending capacity. And that's certainly related to the higher prices, what's come about with inflation and whatnot. But like everything else we're talking about, it's not a blanket statement. We don't see the same patterns happening across different populations in the same way. So again, we will dive into that a bit more. And one of the ways that we will dive into it is by referencing what many of you have probably already heard quite a bit about, and that's the K-shaped economy. And as I've often mentioned, there is no magic to the K. It is not a complicated definition. It is simply a very useful visual illustration of what we're seeing in the data, that there are populations that, given the conditions of a rising stock market, increased property values for homeowners, higher incomes for many portions of the population, we're seeing people that have been thriving, that whose financial wealth and financial status has been increasing over the last several years and continues to increase. And at the same time, of course, we have people that are falling. We see people that are struggling with higher prices, trying to make monthly ends meet, having to rely more upon credit to do so, and ultimately having to start making choices about what bills can they afford to pay this month and what do they have to let slide. So the K is basically just that. It's referencing the fact that people are thriving and people are struggling, which is not a new phenomenon. It's always been the case. The reason that it's so prominent now is that we see that both of those sides of the K are growing simultaneously. We have more people growing in their financial lives, and at the same time, we have more people struggling, which obviously means that the people in that middle, the mythical middle, Ian called them, they are shrinking. That population is shrinking, and that's important because that's the middle class. Those are where the averages that we've been talking about live, and those high level average numbers are describing less and less of the population, and even the populations that those numbers are describing right now doesn't tell where they're heading. It's simply saying what they are right now, and things are going in different directions. So Ian, let me toss out a question to you. I've been talking about the difference of averages, and you mentioned differences between average and median. Could you sort of go into some of the explanation of what we mean by that illusion of average and what you're seeing on the wealth side?
When we're talking about wealth, which is just one component of the sort of series of financial levers or pressures that people have when they look at their overall financial being, and you touched on really the breadth of them. In wealth, we see that it's a very sharp picture of who has the ability to increase in wealth and who has actually the pressures on them that they don't have that luxury to put money aside to be able to do that. And that really does affect that middle section, although I'll get to a little bit where we did see a little bit of a buffering of that middle in the last year. And what we're seeing is not only a sharpness in the curve, you're looking at the households in terms of which households are on either end of the K, and you might think, gosh, that angle of that K is getting a lot sharper. It's kind of breaking out. I would like to also always look at a second sort of metric associated with that, which is for us in wealth, the assets. And so how thick is that line? So we are seeing that the households shift and separate, but are we also seeing the assets get more heavily weighted on one end or the other?
And on that, we're talking about the K, and we're historically, a lot of folks have referenced it, from an inferring standpoint. We infer that some people are struggling. We infer that some people are thriving because we look at a single dimension: income, assets, credit score, things like that. What might be helpful is to sort of set the table by saying, we have the ability to look holistically, across these households, these consumers, through the Market Pulse Index, which is a measure that looks across household wealth, income, credit, durability, all of these different financial components, and creates an index score of 1 to 100. So when we're talking about the thrivers, the people that have a growing financial life, we're talking about consumers that have an index value of 80 or greater. Conversely, if we're talking about the strugglers, who we are referencing in that case are populations whose index values are below 50. So that 50 to 79 range is the middle tier that we're focused so much on, that is both shrinking as well as continuing to move up and down. Some of those are moving up and joining the thrivers. Some of them are moving down and joining the strugglers, creating this bifurcated trajectory here. So that's what we're talking about. And yeah, I like what you were saying about the averages. There was an analogy that I had heard a long time ago and had forgotten about it. And then it came up recently in a conversation and I really liked it. I'm going to use it for many times in the coming months. And that is the man in the oven. If you have a guy in a kitchen whose head is in the oven and whose feet are in the freezer, his average body temperature is perfectly normal.
That's right. Yeah.
But that's not telling the story of what's going on with that individual. Yeah. And I think that's a very useful, visceral illustration of what we're seeing to a degree in the data. And it's why, to your comment very early on in this podcast, when you said, we look at median because we see that shrinking. Even as total wealth and average wealth is increasing, the median is going down. That's obviously telling the story. There's more of those consumers with their feet in the freezer that are experiencing a drawdown on their wealth, even if overall wealth is increasing.
Yeah, I like that. I'm going to steal that, Tom. Man in the oven.
You go right ahead. Now that we've sort of established what we mean by the K and that we are in fact seeing that, within the data that we're looking at, what are some either obvious or less obvious long-term impacts of this K, of these trajectories that different populations are taking? I mean, at the end of the day, why does it matter that we're seeing this split across different consumer groups?
You could look at it in several different ways. I have heard lately that we might be entering a new Gilded Age. And if you're a history buff, you can kind of remember that the previous Gilded Age that the U.S. went through didn't end very well. So when you see significant populations that don't have the economic resources or maybe some of the levers to raise themselves up that they previously had, it's really going to disrupt the economy, not only in financial institutions, but we will see disruption there. I think one of maybe the hidden impacts of what's going to happen in financial institutions is you're going to see a reduction in the number of banks, for instance. We've got about 9,000 credit unions and banks and neobanks together. Now, there are other competitive pressures that they are faced with, especially kind of your more traditional brick and mortar banks. But as we see a concentration of the population who can provide banks and credit unions with the deposits that they need to offset their loan balances to then also be profitable, a shrinking population at the top of the K. Right now, it's about 10% of the U.S. household hold about 72. You could think about 10% hold about 3/4. You're going to have so many institutions that are going to be able to engage those households. And the bottom, as it grows, it's already half the households, about 54%, don't have over $100,000. And their assets have been shrinking in the last 4 years. We've seen them decline by about, 17, 18%. The number of financial institutions that are going to be able to serve that mass market, it's going to get a lot smaller because they're just not going to be able to be profitable. There's going to be many more consumer households that need those services, but there's not going to be as many financial institutions that can remain solvent and be able to support that part of the market. So you can see this increased competition and a reduction, really a reduction in those financial institutions. You're only going to see it there, though. You can also see it in different parts of the economy, in ways maybe that we didn't expect. If you're familiar with Delta Airlines, the way they're reacting to the K-shape is not by maybe increasing the number of seats in their planes that have economy seats. They're going the opposite direction because travel is discretionary. So they're seeing that people who have money are traveling more, and they're increasing their premium footprint in their airplanes. But if you go to sort of the consumer durables, the things that people buy every day that are mass market, you see the premium brands having to start actually discount. I just read that PepsiCo would reduce the price of their chips, for instance, so they can start competing against generics. So you're going to see these ripple effects across the economy where people who don't have enough money to afford what was maybe be an affordable luxury in the past when times were tough are going to have to start turning to focusing on really just paying for those non-discretionary items and having very, very little discretionary spend. But you're also going to see more creative services come up. I think we're probably all familiar with buy now, pay later. We're starting to see a new term, FNPL, or fly now, pay later, where people will say, hey, I've got to take a vacation. They're putting it on cards. They're financing, these sort of discretionary trips and expenses that they previously would save for, your old Christmas club. They just don't have the resources to do that anymore. So they have to put more of their money onto credit, which is going to change the nature of that cycle. When the first comment I made about what's going on with banks and credit unions, if you have more consumer debt, more consumer credit, you're going to have higher deposits. And if those aren't available in certain populations, then you're going to have new players come in to try to service that in more creative ways. So that's what we're seeing kind of in the general area. I'm sure you're seeing the same in credit and lending or something similar.
Yeah, I was just going to say, you bring up some fascinating examples in sort of the retail and broader commercial space.
Yeah.
And I was going to mention that we do see very similar patterns within the FI industry, the financial industry, within FI. And I liked the Delta, example that you provide, because it's so easy for most of us when we think of the K, we get drawn to the lower part of the K for a good reason. I mean, it's totally understandable. That's where the struggle is. That's where risk is. That's where narrower margins are.
Right.
But it's important for us to not lose sight of the other part of the K. It's smaller, but it's important. And I think with financial institutions, it is important to understand, okay, who is more likely to be struggling and becoming, under more financial stress. We want to be able to proactively work with that and manage that as best we can. But there is also that other side of the K, and who is growing, who has the money to grow deposits, who has the money to invest, to grow assets and have the financial activity that many of our institutions are focused on trying to grow. So I love that example because it's illustrative of needing to keep both sides of the K in mind. You also said one thing that I wanted to pick at a little bit as well, in the growing population that has assets under $100,000. You call it the mass market, population, we call it. I think that's important because what we have seen on the credit side, on the overall financial health side, when we look at the Market Pulse Index for those populations, that is the one distinguishing metric above all others that can predict, who is going to have a tougher time in the future, right, and who is going to thrive, moving forward.
Yeah.
And when you think about it, it makes sense because for those households, those consumers who don't have those liquid assets that you mentioned to draw upon as prices get higher, when emergencies come around, they're going to struggle. they won't have those assets to fall back on. They are going to slide down. And in fact, when we looked at the population over the last year and a half that went from the middle tier down into the bottom tier, the strugglers, the strivers, 99% of them fell in that mass market population. They had under $100,000 in liquid assets that they could draw upon. Conversely, of the population that moved from that middle class up into the strivers that grew over the last year and a half, not shockingly, they had over $100,000. Yeah, and of course, this doesn't negate the fact that every situation is different, and it doesn't mean that if you have less than $100,000, you're doomed to fall down. But that pattern is very distinctive. That and the reality dictates that that's the case. That as prices rise, if you are dealt with an emergency, expense or even a planned expense,
that's right,
you're gonna have a tougher time meeting that, and certainly a much tougher time in growing your overall wealth and assets and financial status, given what you're starting with. And that's why we particularly see that exasperated in the younger generations who haven't had the time to build up that nest egg, so to speak, those assets. So
definitely true.
That might be a good transition to start talk about some of those younger generations and what we see. I do want to talk about the wealth transfer that's coming up. Because
that little event that's on the horizon.
We've heard that loud and clear that there's a lot of interest in knowing about that.
Yeah.
But before we do that, let me maybe set the stage a little bit, and let's talk about some of those younger generations, Gen Z in particular. What are you seeing in terms of Gen Z? How are they different from previous generations, and what makes them worthy of our attention? Why are they valuable customers at this point?
Yeah, those young kids, right? They're always different.
Kids.
It seems like every generation, they're different. I do think that there is a little bit of a different situation with the Gen Z than maybe we saw in the millennials or previous generations where they were younger. And a lot of it is because they have been grown up in a frictionless sort of experience, whether it's their kind of consumer behavior, of the Amazon experience or the Grubhub experience of when they want something, they can get it. It doesn't mean they're lazy, but they're able to control a lot more of their lives on the schedule that they want. I call it an appy life versus a happy life because it's
okay. You could borrow my my man in the oven. I'm going to borrow appy life. That's good.
Deal. And that's not always happy because of the fear of missing out for all those sort of other pressures. But they also have the ability to switch their financial relationships much easier than previous generations. I can walk into a bank or I can go online and open up an account and within minutes have that account established. Within several more minutes, I can transfer funds in between accounts. So I can leave you behind if I don't like the experience that you've just given me and go to a new player. They have also grown up not following their parents into the local branch always, where, the traditional pattern would be, I would follow my parents into the local bank branch and I would open my checking account there. And that's what would start me on my financial journey and establish my relationship with that firm. With options like Chime out there and others that kind of started as spending cards that you would create a relationship as a teen with. And now guess who's opening up checking accounts that I've already then anchored my relationship with you on my card. They have many more options than others had in the past and the ability to shift their relationships when they want. We also hear that they're more values-based, the ESP investing, those sorts of things. I don't know if that's so different than previous generations. For instance, when I came out of college, I'm going to date myself here. I worked in socially responsible investing when, apartheid was still in South Africa. We were tracking who was, active in South Africa and screening stocks for those issues and others. So I think that's always been there, especially with younger generations. But so we've got this sort of ability for them to decide on their own much more frequently and with a lot more power how they want to control their financial life. What makes them valuable is they're young. they can be a customer for 50 to 70 years. So if you treat them right and you establish that relationship, and maybe for that formative relationship years for when they're below 30, you do have that sort of go-to-market presence that they want to be associated with. Because they're another term here you might want to use. They live a FinTalk life. They're also not going to the traditional sources of information for financial advice. They're leveraging the tools that are out there, like on TikTok and other areas, then to guide them. I'd say at least until they get money. Always have this thought that once you get over a certain level, whether it's $1 million or maybe some other level, I think everyone takes a little pause and say, well, maybe I should actually consider some more traditional or brick and mortar solutions where I feel a little more confident that they're
something outside of TikTok for my financial advice. Yeah.
That's right. That, well, it's going to be there tomorrow.
Let's talk about that wealth. Yeah, because a lot of folks are looking at Gen Z as well as millennials, obviously, when we are discussing what's being termed as the great wealth transfer. And on the one hand, I hear why people are interested. And on the other hand, I'm thinking, well, how is this different from any other generation passing the wealth that they accumulated to their offspring, to the younger generations? What's making this so fascinating and so much of a focus for so many people as opposed to any other period in human history?
I say the principle and the driving factor is the dollar amount, especially as the stock market, continues to perform. The early sort of numbers you'd hear about this great wealth transfer where the baby boomers and the silent generation that are also a significant part of the population also hold more than half the wealth. And early estimates I would hear were like, hey, $70 trillion is going to transfer. And that would have been the largest sort of transfer in history. So even though we talk about the concentration of wealth, it's actually been democratized to those who can invest in the stock market, which has been a larger group than in the past. It's not just kind of the landed gentry has to get down to the landed gentry, because if you could hold stock, you kind of moved up then economically, or been able to leverage your home value to invest in stock and do some other sort of wealth growth exercises. But it's really that amount. To the point now, I've heard estimates of it being $125 to $130 trillion. So it's this amazing amount of money that is going to transfer as the baby boomers and the silent generation pass on. And then you do have some of those new characteristics that we just talked about with the Gen Z. However, I see that sort of as the second wave. There's a lot of talk about the Gen Z inheriting this wealth. The first wave of inheritors are really going to be the Gen X and maybe some of your older millennials. They are the direct children of the silent generation and some of those baby boomers.
So it's not that a wave is coming, it's the size of the wave. That's correct. That's
just a wave that's never been seen in the past. Yeah.
Now, do you think, and you mentioned that the democratization of the wealth, and we see that maybe unintuitively at the same time that we're seeing this widening gap, that yes, more people have access to wealth, but at the same time we're seeing more people that are struggling at the same time, and I look ahead at the great wealth transfer. And I wonder how much that's going to exasperate that split between the haves and the have-nots in the younger generations, where we already see it more exasperated than in the older generations. There's more variability when we look at the overall financial health layout of those younger generations than we do the boomers and the silent generations and the retired generations, essentially. And I wonder how much of that transfer, when it happens, is going to exasperate that even further. One of the things that we're already starting to see, and this is potentially just inferment on my part when I'm looking at it, but when we do see some of the Gen Zs and the millennials that are in the upper part of the K, certainly a good chunk of them are because they've come out of college, they're going into high-paying jobs. Yeah, they're taking out their first mortgages, they're handling their credit responsibly. They're off to a great start in their financial lives. But there is also a presence of proximity to wealth that many of them have, and that's harder to measure. So they're still able to live with their folks. That's perfectly understandable as they're paying off student loan debts and other things, or they live in the same neighborhood as maybe there's a higher concentration of wealth, and so there is already that split between the upper and lower parts of the caves within the lower generations. Any thoughts in terms of how the wealth transfer may impact that or exacerbate it?
Yeah, I think you kind of touched on this. I think the first wave, so going to the Gen Xers, I don't think that's going to help kind of flatten out the K and disperse wealth further significantly in the economy. Because also a lot of the Gen Xers who have been able to accumulate wealth have done so, again, if they've been able to invest in the stock market. So I think you're going to see sort of wealthy parents passing on their wealth to wealthy children in general. There's always exceptions, right? But I don't think it's going to be able to help kind of lessen the angles of those K shapes that we're seeing, either the upper or the lower line. I think the bigger question is really what's going to happen when it goes down to the younger millennials and the Gen Z, who, you're right, today don't have significant wealth, and it's highly concentrated if you're trying to find who has, let's say, $250,000 already and is a Gen Zer. There's probably less than 1 million of them. I can't remember the number off the top of my head. But do those households, do those consumers have the ability to accumulate wealth as those previous generations did? And I think what we're seeing in really this K-shaped economy is to do so, they're going to have jobs that are high paying. They're going to have really the ability at some point to be able to buy a house and then start using that equity in their house to grow their wealth. And we're seeing significant pressures that are working against that occurring. And then when we also look at the job market, we've seen some disruption, but what's going to happen with AI in the job market in the next, let's say, 3 to 8 years, is that's going to also start to impact him. So will this generation have on their own the ability to increase wealth? So maybe when they inherit some of that wealth at a second level in this transfer, will it be a significant amount of money then? And then will they have the base that the parents and their grandparents had to then be in that wealthy segment? So I think it's really in that second tier where we start to see the Gen Zs inherit the wealth, though we might start to see some flattening because of these other pressures that are occurring in the economy, in society in general. But the biggest linchpin on will be, will the stock market continue to perform?
Right.
If it does, if it stays on fire, if we don't hit this AI bubble that people, are seeing on the horizon, and it stays on the horizon, and hopefully it does, then yeah, if what we see today grows by 10% next year and 15 or 18% year after year after year, then we will see more of that wealth transfer go down generationally, and the K-shape continue to occur with the same sort of lineage, if you want to use that term, at least the top end. And maybe some folks, as you said, can pull up from the bottom end, but there are going to be these societal pressures on their ability to do so.
Yeah. Oh, those are big ifs. That's what we're talking about, aren't we? So let's, in the couple minutes that we've got remaining here, let's turn it a little more tactical. We're talking about what we're seeing, all of these different things that we're seeing in terms of different populations and glimpses into possibilities in the future. What can FIs do to prepare for any of this? Given the current state and the big ifs that we talked about, in terms of what the future may bring. How do all of the changes that we're talking about impact how financial institutions look at Gen Z and millennials and the broader U.S. consumer base? Yeah,
so some of the ways that they can kind of prepare themselves for this great wealth transfer and start putting themselves in a position for success is to really start now, start to create relationships, not only with, your baby boomer and your silent generation of customers, but also the people around them. Now, you want to do this in a non-creepy way. You want to do it in a way that provides value to them. For instance, if they are a caretaker of that silent generation or baby boomer parent, have a caretaker tool package, a platform that enables them to help manage the money of their mother or father. Give them the ability to do so kind of in an easy way. Give them the triggers and the warnings when things happen that they want to be alerted about. Basically, give them a reason to have a relationship with you now that provides them with a benefit, even though it's indirect. And you can also then kind of look at the other side of that coin for that direct account holder who maybe has a premium tier with you, a platinum level of service. You enable that person to gift it to their family members. So again, that family member sees value in creating a relationship with you now before that money transfers. And, numbers are 75% of those account transitions might also include those transfers of wealth might include an account transfer from away from that institution. So give them value now, create that relationship with them now, start treating them as your customers now. So then when the money does transfer, they already have sort of that positive thoughts about you. They already have a relationship with you. They're more likely then to keep that money with you. You can also do things like add, PFM tools, personal financial management tools for them to leverage. So a number of ways you can establish that relationship with them today.
So some of those consumers that may not have high present values may
That's
have,
right.
exceedingly high lifetime values, and that needs to be accounted for when you're.
Yeah. And it's going to be difficult. It's going to be seen as a cost because there might not be significant benefit today, but you're really trying to invest in the future, that future state of having that positive relationship. And then for some of the other items we talked about, get out on TikTok, which just about everybody is, but get out into the social media, get out into even Reddit, because that's where search engines, if you're using AI or using, and start providing advice to those caregivers. How do you help your parents? Give them educational materials, give them pathways to be able to make a difficult process and maybe a difficult time of their relationship in their lives with their parents easier. So they don't feel the friction of having to handle the financial life of their parent, but it's actually something that you've made an experience that has been very beneficial for them. It's not an easy A plus B equals C sort of engagement there.
I'm going to go completely into my grumpy old man on the porch yelling at the kids to get off his lawn persona, which is not a stretch for me. But I have never been on TikTok. So the thought of like being out there offering financial advice, I'm like, really?
It's the number one channel.
It's a world I need to familiarize myself more with. All right. Last question before we wrap up. We've talked a bunch about how different populations are being impacted. And we've talked about populations in terms of age, in terms of wealth tiers. We've talked about them in terms of overall financial status, or financial well-being. How about regional? How about geographic differences? When we pull back and we're talking about the U.S. averages, for instance, there's obviously differences between different locations within the U.S. Is there anything that you're seeing in terms of wealth movement or volatility across different regions that institutions should know about?
I think we're starting to see some significant changes. If you look at which states provide the largest markets overall for assets, it's still what people refer to as the big five of California, Florida, Illinois, New York, and Texas. Those are still the big five. And if you want to look at median levels too, it's been traditionally the Northeast, and it still is the Northeast with also Hawaii included. But if you break it down a level and start to look at, well, where are we seeing growth in maybe the affluent populations or growth in households that have at least $100,000 in deposits, we are starting to see some shifts. When I look at some of those lists, and I previously saw New York very high. New York as a city, I don't see on those lists as high. Now, does that mean all the money is moving to Florida? Maybe, but also some of the money might be moving to northeastern Pennsylvania and northern Jersey. We also don't see Los Angeles as high on that list, and San Francisco is high on that list. So we are starting to see some of those shifts. The areas that we see some of that growth are really in the Southeast, and there's intense competition among banks to move to the Southeast and create that brick and mortar presence for when I'm driving by and I understand, okay, I've moved to this market, you're in this market. One of the developments I want to keep track of, though, over the next, let's say 3 to 6 years, is to see if the presence of neobanks that only have a digital online presence, or the need to have brick and mortar locally, if that becomes less of an issue on the deposit side than what it has been on the investment side, which is if my broker's making money for me and I move across the country, I'm not going to change that relationship. I might keep it with my broker because he's making money with me. If I'm happy with my bank account and I've got a relationship banking experience with them where I've got my card there, I need a reason then to shift it. And maybe the reasons haven't been as strong now as they were in the past because so much can be done online. So that's a development I want to see if that really occurs as wealth moves and the account holder moves to the institution that they still have a relationship change.
Interesting.
I'll have to see if that does happen. But yes, we are seeing this population shifts.
And that's significant. Something very valuable for our listeners to understand, not just what is happening, but where. So thank you for that. That's all the time that we have for today. Thank you very much for listening in. If you have any further questions or have any other topics that you'd love us to discuss in upcoming podcasts, feel free to reach out to us at advisors@equifax.com. Ian, thank you so much for joining me today. This has been a delightful conversation and hope to do more of it soon.
Yeah, thanks, Tom. I always enjoy it anytime.
The information and opinions provided in this podcast are intended as general guidance only and are subject to change without notice. The views presented during the podcast are those of the presenter as of the date this podcast was recorded and do not necessarily reflect official positions of Equifax. Investor analysts should direct inquiries using the Contact Us box on the Investor Relations section at Equifax.com.